Corporate networks face an escalating barrage of borderless digital threats. Supply chain infiltrations, cloud outages, and coordinated extortion schemes place immense stress on global infrastructure. Following the severe market tightening of 2021, the cost to insure against these threats should, by all logic, be climbing. Instead, the 2026 cyber insurance market has entered a phase of unexpected stabilization. This chart tracks median and average cyber insurance pricing changes. Following the 2021 peak, where carriers raised prices for massive ransomware losses, the data shows a sharp drop. By 2025, that trend line levels out entirely, moving into flat and negative territory. This presents a paradox for risk managers. Systemic risks, like single point of failure cloud outages that impact thousands of businesses simultaneously, are multiplying, yet the price of the average policy is dropping. Standard rate tables do not explain this shift. To accommodate this environment, carriers have moved beyond price adjustments to restructure their capital stacks and underwriting operations. The insurance market is engineering a way out of volatility, building a financial framework designed to absorb catastrophic digital shocks. Look at the scale of global cyber insurance premiums. Gross written premiums stood at $8.5 billion in 2021. By 2026, that capacity will scale to nearly $20 billion. Traditional insurance balance sheets cannot pool enough standard premiums to safely cover $20 billion of highly volatile, interconnected exposure. To handle this, the industry utilizes a tiered capital stack. Standard policies pool localized risks at the foundation, which carriers then pass upward into proportional reinsurance agreements. By sharing premiums and losses with specialized global reinsurers, primary carriers protect their own balance sheets from the impact of severe claim years. The 2026 market expands by integrating this stack into global financial markets. Carriers transfer the highest layer of risk via insurance-linked securities. Institutional investors fund these instruments, purchasing catastrophic bonds or cat bonds to provide the ultimate financial backstop. These bonds do not pay out for standard ransomware. They trigger only during extreme, highly correlated events, like a global cloud infrastructure failure impacting millions of endpoints at once. Offloading catastrophic systemic risk to Wall Street frees internal capacity. This mechanism allows carriers to increase volume while stabilizing premiums for buyers. Capital structure is only half the equation. The operational reality of writing these policies is shifting away from traditional legacy carriers. Consider the recent corporate restructuring at Allianz, which transferred its global standalone commercial cyber portfolio to Coalition, a specialized managing general agent. This acknowledges a limitation in legacy underwriting. Static annual risk assessments cannot keep pace with the hour-by-hour mutations of modern cyber threats. The replacement for the annual questionnaire is the active insurance model, which splits the underwriting ecosystem in two. In this model, traditional carriers provide the long-term financial capacity, while the tech-driven MGA runs continuous digital infrastructure scanning to monitor the insured's attack surface in real time. When a vulnerability is detected, the MGA's incident response team works to patch the flaw before an extortion event occurs. Today's cyber insurance policy functions as an outsourced active cybersecurity operations center integrated directly into the enterprise, extending far beyond the scope of a standard indemnity contract. Active scanning is mandatory because modern threats have mutated beyond basic network breaches. Threat actors have largely abandoned complex data encryption. Today, they execute pure data exfiltration, stealing data and extorting the company with the threat of public disclosure. Alongside extortion, AI-driven attacks are rising. Adversaries deploy model inversion and deepfakes with alarming realism, weaponizing synthetic audio and video to impersonate executives. Underwriters are also absorbing massive losses from a threat vector involving no hackers, non-breach privacy claims. Standard corporate marketing practices, specifically website pixel tracking and biometric data collection, are triggering a wave of class action lawsuits. The plaintiff's bar leverages decades-old statutes, like the 1968 Federal Wiretap Act, to extract statutory penalties reaching $10,000 per individual violation. The reality of the 2026 market is that internal practices often create the most expensive cyber liabilities. Marketing and IT departments violating evolving privacy standards trigger the same financial damage as a foreign state actor. This map tracks U.S. state AI governance legislation for 2025. It illustrates the compounding pressure of fragmented regulatory frameworks governing digital privacy and artificial intelligence. For multinational corporations, this accumulation of individual state laws creates a chaotic, overlapping compliance landscape. Outside the U.S., governments utilize highly centralized, punitive enforcement. Consider Indonesia as a case study in severe regulation. Indonesia's personal data protection law mirrors the strict framework of the European GDPR. Administrative fines for data negligence can claim up to 2% of a corporation's annual revenue. On top of that, their Financial Services Authority enforces strict sectoral mandates. If a bank experiences a cyber incident, they must issue an initial report to regulators within a 24-hour window. Failure to meet these reporting standards leads to heavy fines and regulatory sanctions that can legally halt a bank's operations. Within these punitive regulatory regimes, cyber insurance functions as a mandatory legal defense and a primary mechanism for operational survival. These factors define the 2026 cyber policy. It's an integrated risk management vehicle funded by capital markets, policed by tech scanning, and built to absorb regulatory penalties. Thus, underwriters demand proof of systemic resilience before granting access to this capital stack. Securing coverage now requires total alignment between a company's IT hygiene, their legal compliance, and their operational governance. The modern cyber underwriter has moved beyond simple risk pricing. They now serve as the ultimate auditor of global corporate digital health.